Good morning, Sir Adri and friends. Today we are going to discuss PSAK 1, Presentation of Financial Statement. I am your presenter for today, Gabriella, and these are my partners, Danisha Figlia, Fellyn Liang, and Nickyta Christanti. So PSAK 1 is the basis of all the rules regarding the presentation of financial statements, which were issued for the first time in 2009, which then underwent several revisions in 2013, 2015, and 2019 in form of amendments. So these standards ensure the comparability of both entity financial statements of previous periods and with the financial statements of other entities. And it sets out overall requirements for the presentation of financial statements, guidelines for their structure, and minimum requirements for their content. So these are the scope of PSAK 1. So an entity shall apply the standard in preparing and presenting general purpose of financial statements in accordance with PSAK and does not apply to the preparation and presentation of financial statements of Sharia entities because Sharia entities refer to their own SAK. So we already talked a lot about financial statements, but what is financial reports and what are their purpose? So financial statements are a structured representation of the financial position and financial performance of an entity. The objective of financial statements is to provide information about the financial position, financial performance, and cash flows of an entity that is useful to a wide range of users in making economic decisions. Financial statements also show the result of the management stewardship of the resources entrusted to it. So to meet this objective, financial statements provide information about an entity's first asset. So there are three kinds of asset: current asset like cash, inventories, and receivables; fixed assets like PPE; and intangible assets like goodwill. The second one is liabilities. So liabilities are divided into short-term liabilities like salary payable and long-term liabilities like bonds payable. The third one is equity. The fourth one is income and expenses, including gain and losses. And the fifth one is contribution by and contribution to owners in their capability as owners. And the last one is cash flows. So this information, along with other information in the notes, assists users of financial statements in predicting the entity's future cash flows and, in particular, their timing and certainty. Next, the complete set of financial statements. So a complete set of financial statements comprise the first one is a statement of financial position at the end of the period. The second one is a statement of profit or loss and other comprehensive income for the period. The third one is a statement of changes in equity for the period. The fourth one is a statement of cash flow for the period. The fifth one is notes, comprising material accounting policy information and other explanatory information. And the fifth A or EA is comparative information in respect of the preceding period as specified in paragraphs 3A and 3A. And the last one, a statement of financial position at the beginning of the preceding period when an entity applies an accounting policy retrospectively or make a retrospective restatement of items in its financial statements, or when it reclassifies items in its financial statement in accordance with paragraph 40A to 40D. Note that an entity shall present with equal prominence of all financial statements in a complete set of financial statements, and the entity's management is responsible for the preparation and presentations of financial statements. So the next one is the general features of financial statements. So the first one is fair presentation and compliance with PSAK. So financial statements shall present fairly and shall financial statements shall present fairly the financial position, financial performance, and cash flows of an entity. Fair presentation requires the faithful representation of the effect of transactions, other events, and conditions in accordance with the definition and recognition criteria for assets, liabilities, income, and expenses. The second one is going concern. So when preparing financial statements, management shall make an assessment of an entity's ability to continue as a going concern. An entity shall prepare financial statements on a going concern basis unless management either intends to liquidate the entity or to cease trading or has no realistic alternative but to do so. The fifth one is the accrual basis of accounting. So an entity shall prepare its financial statements except for cash flow information using the accrual basis of accounting. When the accrual basis of accounting is used, an entity recognizes items as assets, liability, equity, income, and expenses when they satisfy the definitions and recognition criteria of those elements. The fourth one is materiality and aggregation. So an entity shall present separately each material class of similar items. An entity shall present separately items of dissimilar nature or function unless they are immaterial. The fifth one is offsetting. So an entity shall not offset assets and liabilities or income and expenses unless required or permitted by PSAK. The sixth one is frequency of reporting. So an entity shall present a complete set of financial statements, including comparative information, at least annually. The seventh one is comparative information. So we got to comparative information. The first one is the minimum comparative information. So an entity shall present as a minimum two statements of financial position, two statements of profit or loss and other comprehensive income, two separate statements of profit or loss, two statements of cash flows, and two statements of changes in equity and related notes. The second one is additional comparative information. So for an example, an entity may present a third statement of profit and loss and other comprehensive income. The last one is consistency of presentation. So an entity shall retain the presentation and classification of items in the financial statements from one period to the next.
So let's go to the different of balance sheet of PSAK 1 and IAS 1. So, and in PSAK 1, the liability comes first and the equity comes last. And then for the IAS 1, the equity comes first and the liability comes last. Next is items in financial report. So the presentation of current and non-current assets and short-term and long-term liability as separate classification. Unless presentation based on liquidity provides more relevant and reliable information, then a liquidity order is used. Financial companies based on liquidity. Separation of the amount is expected to be recovered or sold after more than 12 months for each asset and liability item, if the value are combined. Current asset. Classification of current assets. If expect to realize the asset or intends to sell or use it within the normal operating cycle. On asset for trading purpose, expect to realize the set within 12 months after reporting or cash equivalent or PSAK 2 cash flow statement, unless the asset is restricted in its exchange or used to settle liabilities for at least 12 months after the reporting period. An entity classifies sets that do not fall into this category as non-current sets. Current liabilities. Classification of current liability if expect to resolve such liability within its normal operating cycles, have such liabilities for trading purpose. The liability is due to be settled within 12 months after the reporting period or does not have full right to postpone settlement of liabilities for at least 12 months after the reporting period. The entity classifies liabilities that do not fall into these categories as long-term liabilities. Last but not least, liabilities. So, liabilities are financial liabilities that mature within 12 months after the reporting period are classified as short-term liabilities. If the entity doesn't have conditional right to refinance. Violation of the agreement that results in the creditor requesting acceleration of payment, then the liability is presented as a short-term liability, even though the creditor permits a delay in payment for 12 months after the reporting date, but its approval is obtained after the reporting date PSAK 1 loss and profit report.
Okay, so the next one is statement of profit or loss and other comprehensive income. So in PSAK 1 2009, the title of the statement was Statement of Comprehensive Income, while in PSAK 2013, the title of the statement is Statement of Profit or Loss and Other Comprehensive Income. The statement of profit or loss and other comprehensive income presents an entity's performance over a specific period. An entity presents profit or loss, total other comprehensive income, and comprehensive income for the period. Entities have a choice of presenting this in a single statement or as two statements. The single statement approach includes all items of income and expenses and includes each component of other comprehensive income classified by nature. While under the two-statement approach, all components of profit or loss are presented in an income statement. The income statement is followed immediately by a statement of other comprehensive income, which begins with the total profit or loss for the period and displays all components of comprehensive income. Okay, the next one, items to be presented in statement of profit or loss and other comprehensive income. Number 1, revenue. Revenue presenting separately interest revenue calculated using the effective interest method. Number 2, gains and losses. Gains and losses arising from the derecognition of financial assets measured at amortized cost. Number 3, finance cost. Number 4, impairment losses, including reversals of impairment losses or impairment gains. Number 5, share of the profit or loss of associates and joint ventures accounted for using the equity method. Number 6, gain arising on reclassification of a financial asset from the amortized cost category to fair value through profit or loss or FVPL. Number 7, cumulative gain or loss on reclassification of a financial asset from the fair value through other comprehensive income or FVOCI category to FVPL that was previously recognized in other comprehensive income and is reclassified to profit or loss. Number 8, tax expense. And number 9, a single amount for the total of discontinued operations. This comprises the total of post-tax profit or loss of discontinued operations and the post-tax gain or loss recognized on the measurement to fair value less cost to sell or on the disposal of the assets or disposal groups constituting the discontinued operation. Okay, the next one is other comprehensive income. An entity shall present items of other comprehensive income to be classified by nature and grouped into those that will be reclassified subsequently to profit or loss, and those that will not be reclassified. An entity discloses reclassification adjustments relating to components of other comprehensive income. The PSAK 1 amendments clarify that the entity's share of items of comprehensive income of associates and joint ventures is presented separately, analyzed into those items that will not be reclassified subsequently to profit or loss, and those that will be so reclassified when specific conditions are met. An entity presents each component of other comprehensive income in the statement either the first one, net of its related tax effects, or number two, before its related tax effects with the aggregate tax effect of these components shown separately. Okay, so this is the example of the statement of profit or loss and other comprehensive income.
Next, we're going to talk about the information in statement of profit or loss and other comprehensive income statement. When income or expense items are of material value, then the entity discloses its nature and amount separately. The cost of separation are decrease in the value of inventories or fixed assets and their recovery, restructurings of the activities of an entity and reversals of any provisions for the cost of restructuring, disposal of fixed assets like PPE, disposals of investment, discontinued operation, litigation settlement, other reversals of provisions. Entity presents an analysis of expenses recognized in income statement by using classification based on its characteristics or its function within the entity, which it can provide a more reliable and relevant information. Next is the classification of expense. So there are two classifications of expense. The first one is by nature and the second one is by function. So by nature is selection is based on its historical and industry factors. It's easier to use classification by nature since we don't have to allocate the expense by its function. So here's the format for the classification of expense. We have revenue, other income, changes in inventories, raw materials, employee benefit expense, depreciation and amortization expense, other expenses, total expenses, and profit before tax. Next is the classification of expenses by function. If an entity categorizes the expenses by function, then additional information on the nature of expenses, at a minimum depreciation, amortization, and employee benefits expense must be disclosed. So here's the format. The first one is revenue, cost of sales, then we get the gross profit, and then we have other income, at distribution costs, and then administrative expense, other expenses, then we'll get profit before tax. Statement of changes in equity. The statement must show the comprehensive income for the period, showing separately the amounts attributable to owners of the parent and to non-controlling interests, the effects of any retrospective application of accounting policies or restatement made in accordance with PSAK 8, separately for each component of other comprehensive income. And next is reconciliations between the carrying amounts at the beginning and the end of the period for each component of equity, separately disclosing the profit or loss, other comprehensive income, and transactions with owners, showing separate contributions by and distributions to owners and changes in ownership interest in subsidiaries that do not result in a loss of control. An entity shall present either in the statement of changes in equity or in the notes the amount of dividends recognized as distributions to owners during the period and the related amount of dividends per share. Next, we have statement of cash flow. The statement must show total comprehensive income for the period, showing separately amounts attributable to owners of the parent and to non-controlling interests, and then also show the effect of any retrospective application of accounting policies or restatements made in accordance with PSAK 8, separately for each component of other comprehensive income. Reconciliations between the carrying amounts at the beginning and at the end of the period for each component of equity, separately disclosing the first one is profit or loss, and next is other comprehensive income, and the last one is transaction with owners, showing separately contribution by and distribution to owners and changes in ownership interest in subsidiaries that do not result in a loss of control. So in other comprehensive income, it's an analysis of other comprehensive income by item is required it to be presented either in the statement or in the notes. And next, the following amounts may also be presented on the face of the statement of changes in equity, or they may be presented in notes. The amount of dividends recognized as distributions and also the related amount per share. And also we have here is the notes to the financial statements. It presents the information about the basis of preparation of the financial statements and the specific accounting policies used. Next is disclose any information required by the IFRS that is not presented elsewhere in the financial statements. And the last one is to provide additional information that is not presented elsewhere in the financial statements, but is relevant to understanding of any of them. That's all from us. Thank you.